China just labeled Pi Network a high-risk asset. Most people think it's because of scams or speculation, but that's not the real story. The real reason involves a number: GCV 314,159. It sounds impossible. It sounds crazy. And that's exactly why regulators are panicking. Because that number didn't come from hype, it came from an economic model. A model so controversial that when Chinese authorities saw it gaining traction, they moved fast to shut it down. While everyone's focused on the price dropping to 22 cents, they're missing what's really happening. This isn't about price anymore. This is about a mathematical formula that threatens the way governments control money. And now, some exchanges are quietly discussing whether to delist Pi. Others are watching closely, waiting to see if this model actually works. Because if it does, it changes everything. Hello again, Pi Network pioneers. I'm your host, Nathan. Before diving deep into our video, let's greet and welcome my incredible pioneers from around the world. Whether you're watching from Nigeria, Papua New Guinea, United States, India, Philippines, Canada, Kenya, or anywhere else on this beautiful planet, I'm absolutely thrilled to share this incredible news with you today. Before we dive in, make sure to hit that subscribe button and tap the notification bell so you're always in the loop with the latest Pi Network updates. And don't forget to drop a comment saying Pi Network to the moon along with your country and flag. Let's fill the comments with pioneer pride and show the world how powerful and united our global community really is. So, let's dive right in. And today, I'm going to show you the dots nobody wants connected, the formula they tried to ignore, and why China's attack might be the strongest validation Pi Network has ever received. But first, we need to understand what this number actually means and why it has governments so nervous. Let's talk about the number everyone's laughing at, $314,159 for one PiCoin. On the surface, it sounds ridiculous. Bitcoin is around 90,000, Ethereum is 3,000. How could a mobile mining app be worth more than both combined? But here's what most people don't understand. That number isn't a prediction. It's not hype. It's something called the Global Consensus Value, or GCV. According to community documentation released in November, the GCV is based on a trust-weighted algorithm. It uses 4 layers of data pulled directly from blockchain activity. Automated market makers, oracle aggregators, chain feeds, and mirror systems all feeding into one calculation. The system uses a self-correcting formula. When the value drifts from $314,000, the network automatically adjusts by minting or burning tokens. It's designed to maintain stability through math, not through market speculation. Now here's where it gets interesting. This isn't just community wishful thinking anymore. Pi Network has reportedly embedded this value into their infrastructure. Their supernodes, their Nexus system, their entire economic engine operates with this number hard-coded as a constant. Think about what that means. They're building an entire economy around a fixed value that ignores traditional market forces. An economy where one Pi equals $314,000, regardless of what exchanges say. And that's exactly what makes governments nervous. Because if this model works, if people start accepting this value for real transactions, it creates a parallel economy that central banks can't control. But there's more to this formula than just the number itself. And understanding where it comes from reveals why this threatens the entire financial system. So where does 314,000 come from? Why that specific number? It starts with the mathematical constant pi, 3.14159, the number that defines circles, waves, cycles, a number that appears throughout nature and mathematics. Pi Network took that constant and scaled it by 100,000, 3.14159 becomes 314,159. It's symbolic. It ties the currency to its name and creates a memorable anchor. But the real power isn't in the symbolism, it's in how the system maintains that value. According to technical reports, the network uses something called contribution-based mining. You don't earn Pi by buying it or trading it. You earn it through engagement, validation, and participation. Your effort creates the value. This is completely backwards from traditional finance. In normal markets, capital creates value. Rich people with money can buy assets and control prices. But in Pi's model, participation creates value. Regular people contributing to the network determine worth. The GCV takes this concept further. It says that Pi's value should reflect the collective contribution of millions of users, not the speculation of a few traders. It's a statement that value comes from utility and consensus, not from market manipulation. Now imagine you're a government. You control your currency by controlling its supply and value. But suddenly, there's a network of millions of people who've agreed on a completely different value system, a system you can't manipulate because it's built on math and community consensus. That's dangerous. Not because it's a scam, but because it works outside your control. And that brings us back to why China moved so aggressively. Because what happened last week wasn't random timing. On December 6th, Chinese authorities made their move. 7 national associations, including China's Internet Finance Association, issued a joint warning. They didn't just warn about crypto in general. They specifically named Pi Network. They called it an air coin, a term that means a token without real backing. They warned people to stay away, citing risks to investors and financial stability. But here's what's interesting about the timing. This warning came right as the GCV model was gaining serious traction. Community discussions about the 314,000 value were spreading. Merchants were starting to reference it in pricing. The infrastructure embedding this value was being documented and shared. China saw momentum building around a decentralized value system, and they acted fast to crush it before it became normalized. Think about why China specifically would care. They already banned crypto trading back in 2021. Bitcoin, Ethereum, all of it. So why issue a specific new warning about Pi in December 2025? Because Pi is different. It's not about trading. It's about creating an alternative economic system, one where value is determined by consensus among regular people, not by central banks or governments. For a country that wants complete control over its financial system, that's existential. It's not just about protecting investors, it's about protecting power. The warning had immediate effects. The price dropped to 22 cents. Exchanges started risk assessments, people panicked and sold. Mission accomplished, from China's perspective. But here's what they didn't count on. The attack itself might have validated exactly what they were trying to discredit. Because when powerful governments attack something, they're not doing it because it's weak and failing. Let me ask you a question. When was the last time Chinese authorities issued a specific warning about a failed crypto project? They don't. Small projects that don't matter just fade away. They don't get official government notices from 7 national associations. The fact that China targeted Pi specifically tells you something. It tells you they see it as significant enough to worry about. And in the world of decentralized finance, government fear is often the strongest form of validation. Look at Bitcoin's history. Governments around the world tried to ban it, regulate it, control it. Every attack made it stronger. Every prohibition proved it was something they couldn't ignore. Pi Network is experiencing a similar dynamic. China's attack is creating the Streisand effect. More people are now asking, what is this Pi Network? Why are governments so scared of it? What's this $314,000 model everyone's talking about? The attack is spreading awareness faster than any marketing campaign could. But there's another layer to this validation. While China is attacking, Europe is doing the opposite. Pi Network recently achieved compliance with MiCA regulations. That's Europe's strict framework for crypto assets. Getting MiCA compliance isn't easy. It means your project meets European standards for transparency, security, and legal operation. And it opens doors for institutional integration that most crypto projects can't access. So you have China attacking on one side and Europe approving on the other. That's not a project failing. That's a project caught in the middle of a global regulatory battle over the future of money. And while that battle plays out at the government level, something else is happening on the ground that most people aren't noticing. While the news is terrible and everyone's panicking, look at what's actually happening with the token supply. In December, about 190 million Pi tokens are scheduled to unlock. That's a massive amount of new supply hitting the market. Traditional economics says that should crash the price even further. But think about this differently for a second. If you were someone with serious capital who wanted to buy a huge position in Pi, when would you want to do it? Obviously, when the prices crashed and everyone's scared. When regulatory pressure has pushed out the weak hands. When massive new supply is about to become available and sellers are desperate. This is how institutional accumulation works. You don't buy when the price is high and everyone's excited. You buy when there's maximum fear and minimum competition. Look at the technical patterns right now. Analysts are seeing what they call a coiled spring formation. Selling pressure has pushed the price so low that it's created compressed energy in the market, the kind of setup that often precedes major rallies. Some technical analysts are predicting potential bounces of 30 to 90% once this pressure releases. That's significant movement from 22 cents. Now combine that technical setup with the December unlock. You have maximum supply becoming available right when the price is at maximum fear levels. That's the perfect environment for large buyers to accumulate massive positions without moving the market. The public sees a crisis. Smart money sees an opportunity. And here's what makes this even more interesting. The GCV model doesn't care about exchange prices. It operates independently. So while traders are panicking about 22 cents, the entire Pi ecosystem is still operating as if the value is much higher. But this creates a strange dynamic that we need to talk about because it reveals something important about how alternative economies actually function. Here's something most people miss about Pi Network. While exchanges show 22 cents, there's an entire economy operating at completely different valuations. According to community reports, merchants in various regions are accepting Pi for goods and services, but they're not pricing based on exchange rates. They're using the GCV model as a reference point. Someone might accept one Pi for something worth $300, not 22 cents, because within that community, the consensus value is what matters, not the speculative exchange price. This creates what economists call a dual pricing system. Inside the Pi ecosystem, value is determined by community consensus. Outside, on exchanges, value is determined by market speculation. Two completely different economies operating simultaneously. Now, which one is more real? The exchange price that fluctuates based on fear and manipulation, or the consensus value that's based on actual usage and agreement among participants? This is where the GCV model gets interesting. It's not trying to compete with traditional markets. It's trying to replace them. It's saying we don't need exchanges to tell us what our currency is worth. We'll decide among ourselves based on utility and contribution. If this works, if enough people adopt this model, it becomes self-fulfilling. The consensus value becomes the real value because that's what people actually use for transactions. But there's a catch. For this to work long-term, you need scale. You need enough people participating in this parallel economy that it becomes sustainable. And that's where the 2026 timeline becomes critical. Let's talk about what happens after all this chaos settles down. After the December unlock, after the China situation stabilizes, after the holiday season ends. January 2026, that's when things could get very interesting. Pi Network has MiCA compliance. That means European institutions can legally integrate it. Banks, investment firms, hedge funds, they have the regulatory green light. But they're not going to integrate while the price is 22 cents and there's regulatory drama. That's not how institutions work. They wait for clarity. They wait for stability. They wait for the dust to settle. 2026 is when that dust settles, when the unlock is complete, when institutional systems have been prepared, when the regulatory picture is clearer. And when billions of dollars of institutional money tries to enter a crypto market, the price has to rise. It's not optional. The liquidity demands alone force prices higher. You can't run institutional-grade finance on a 22-cent token. The price has to accommodate the volume these institutions need to trade. That means significant appreciation just to handle the infrastructure requirements. Now, will it reach 314,000? Almost certainly not in the near term. That's still aspirational. But could it reach $10, $50, $100? Those become realistic if institutional integration actually happens. And here's the interesting part. The GCV model creates a psychological anchor. Even if the market price is much lower, the existence of that 314,000 target keeps people thinking bigger. It prevents them from settling for small gains. It's like setting a massive goal. You might not hit the goal exactly, but you'll go much further than if you had set a small goal. But before we get too optimistic, we need to talk about what could go wrong. Because there are real risks here that nobody should ignore. Let's be brutally honest about the problems Pi Network faces. First, the exchange situation. If more platforms follow China's lead and delist Pi, liquidity dries up. Less liquidity means more volatility. More volatility scares away institutional investors. It's a vicious cycle. Second, the unlock risk. 190 million tokens is huge supply. If the market can't absorb that smoothly, we could see 22 cents drop to 10 cents or lower. The technical analysis showing a coiled spring could be completely wrong. Third, the institutional money we're talking about isn't guaranteed. MiCA compliance opens the door, but institutions still need actual reasons to integrate Pi. They need to see real usage, real adoption, real value beyond just community consensus. Fourth, and this is the biggest risk, what if mainstream adoption never happens? What if Pi remains a niche project with limited real-world use? Then all the formulas and models and consensus values don't matter. Price follows demand, and without demand, there's no support. The GCV model is innovative, but it's also untested at scale. We don't know if a parallel economy based on consensus value can actually compete with traditional markets. We don't know if people will continue accepting $314,000 valuations when exchange prices are a fraction of that. And there's a psychological risk too. The longer the exchange price stays low while the GCV stays high, the more cognitive dissonance that creates. Eventually, one has to give. Either the consensus breaks or the market adjusts. We don't know which way it goes. These are serious risks. Anyone telling you Pi is a guaranteed win is either lying or doesn't understand markets. There's real possibility this doesn't work. But here's why some people are still taking that risk despite all of these problems. Let me show you why this situation is interesting from a risk-reward perspective. If you buy Pi at 22 cents and it goes to zero, you lose 100% of your investment. That's your maximum downside. You lose what you put in. But if you buy at 22 cents and it recovers to just $2, that's over 800% gain. If it reaches $10, that's over 4,000%. If it somehow reaches even a fraction of the GCV target, that's generational wealth. This is what investors call asymmetric risk. The potential upside is dramatically larger than the potential downside. When something's already down 92% from its high, the risk profile changes completely. Now, this doesn't mean you should mortgage your house to buy Pi. It means that if you can afford to lose what you invest, the mathematics of the bet become interesting. Think about it this way. If you put in $100 and lose it all, that's $100 gone. But if that $100 turns into $800 or $4,000 or more, that's life-changing relative to the risk you took. This is exactly the type of situation where smart money operates. They take calculated risks on scenarios where the potential reward vastly outweighs the potential loss. And right now, with maximum fear, regulatory pressure, and price crashes, we're at that point. The risk is real. The potential loss is real, but so is the potential upside. The question isn't whether Pi will definitely succeed. The question is whether the probability of success multiplied by the potential return is greater than the probability of failure multiplied by the potential loss. That's a calculation everyone has to make for themselves based on their own financial situation and risk tolerance. But there's one more piece to this puzzle. Something about timing that could make the next few months critical. Let's put all the pieces together and see what picture emerges. You have China attacking because they see Pi as a threat to financial control. You have Europe approving because they see it as innovation within regulatory frameworks. You have a massive token unlock creating supply. You have technical patterns suggesting a potential rally. You have a parallel economy operating on consensus value. And you have institutional pathways opening in 2026. All of these elements are converging in the next few months. December unlock, holiday season, New Year, first quarter of 2026, when institutions return from holidays and start implementing new strategies. This convergence creates a critical window. Either Pi emerges from this period stronger, with the unlock absorbed, with regulatory clarity, with momentum building, or it doesn't. And the project fades as institutional interest moves elsewhere. We're at an inflection point, the kind of moment that determines whether something survives and thrives or dies quietly. History shows that these moments are when fortunes are made or lost. When Bitcoin was under attack and trading for hundreds of dollars, most people sold. The ones who understood what was happening accumulated. Years later, that decision defined their financial futures. Pi Network is at a similar crossroads. The fundamentals are interesting. The model is innovative. The community is large. But the risks are real. The challenges are significant. The outcome is uncertain. What happens next depends on factors we can't fully control. Regulatory decisions in multiple countries, adoption rates among merchants and users, technical execution by the development team, market conditions in crypto broadly. But here's what we do know. Maximum fear rarely lasts forever. Markets that crash dramatically often bounce equally dramatically. And projects that survive government attacks tend to emerge stronger. The question is whether you can see past the fear to recognize the setup, whether you can handle the uncertainty, whether you can afford the risk. Before we wrap up, I need to be completely clear about something. The $314,000 valuation is aspirational. It's a long-term vision. It's not happening tomorrow or next year. If someone tells you Pi is definitely reaching that price, they're wrong. Nobody knows what will happen. Markets are unpredictable. Adoption is uncertain. Regulatory environments change constantly. What we're really talking about is whether Pi can establish itself as a legitimate player in the crypto space. Whether it can reach $5, $10, maybe higher over time. Those are realistic possibilities if things go well. The GCV model is interesting as an economic experiment. It's innovative as a consensus mechanism, but it's not a guaranteed price target. It's an anchor, a reference point, a vision that might or might not materialize. The current situation at 22 cents represents maximum pessimism. China's attack, delisting risks, supply unlock concerns. All the bad news is priced in. That creates opportunity for recovery, but it doesn't guarantee it. You need to understand the difference between realistic upside and fantasy predictions. One is based on market mechanics, adoption curves, and institutional integration. The other is based on hopeful mathematics that doesn't account for reality. Those are the questions that matter. not whether it hits 314,000. The value of understanding the GCV model isn't that it predicts the exact price. It's that it shows you the thinking behind the project, the ambition, the different approach to value creation. And that brings us to the final question. What should you actually do with this information? So here's where we are. Pi Network is under attack from China. The price has crashed to 22 cents. Exchanges are considering delistings. A massive supply unlock is coming. That's the bad news, and it's real. But the other side shows technical patterns suggesting a potential rally. European regulatory approval opening doors, a parallel economy operating on consensus value, and a community of millions who believe in the model. Nobody can predict what happens next with certainty. Not me, not any analyst, not anyone. What I can tell you is this. Government attacks often validate what they're trying to suppress. Maximum fear often precedes major reversals. And asymmetric risk-reward setups create opportunities for calculated bets. Whether Pi Network succeeds long-term depends on factors we can't control. Adoption, development, regulatory changes, market conditions, all uncertain. But what we do know is that the current price reflects maximum pessimism, and maximum pessimism rarely lasts forever. You have a choice. You can look at this and see a dying project heading to zero. Or you can look at it and see all the pieces falling into place for a potential recovery. Neither view is wrong. They're different interpretations of the same information. What matters is being honest about the risks, understanding what you're getting into, only investing money you can afford to lose completely. This isn't financial advice. I'm not telling you to buy or sell anything. I'm showing you the picture that most people miss because they're too focused on the fear. The $314,000 model isn't a price prediction. It's a statement about how alternative economies might function. It's an experiment in consensus-based value. It's a challenge to traditional financial systems. Whether that experiment succeeds or fails, we're watching something interesting unfold. A community of millions trying to build something different. A mathematical model that makes governments nervous. A parallel economy operating on its own terms. If you found this breakdown valuable, hit that like button. Subscribe if you want more analysis that goes deeper than surface-level panic. And comment your thoughts on whether you think the GCV model has merit or if it's just wishful thinking. Are you buying this dip? Staying away? Watching and waiting? I want to hear your perspective. Thanks for watching. Stay sharp out there. I'll see you in the next one.